Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, welcome to Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Very excited for this year. 2025, let's make it the year that we sort our money out. And one series that we're bringing back that we loved last year was Ask an Advisor. We get some of Australia's top financial advisors. We get them in the studio and we put your questions to them for people who feel like they can't afford an advisor or don't have enough money to speak to an advisor. This is your chance to get your question answered by some of Australia's best advisors. Now, speaking of some of Australia's best advisors, we have one in the studio with us today. Glen Hare, welcome back to Equity Mates.
Thank you. Thank you for having me.
So Glen is co-founder of Fox Hare, and if you would like to speak to Glen and any of the team and you're new to Equity Mates, we do have a form at equitymates.com/advice where you can go and fill out the information and we'll connect you with Glen and the team or a number of other advisors if Glen's not right for you. But Glen, I think we should firstly say thank you for all the awesome work you've been doing with the Equity Mates community over the last 12 months. We've had such great feedback from the community that are now members with you, and we've loved having you on. Your episodes always do so well. So thank you so much. We'll just start from the top.
Awesome. Thank you.
Now, today's episode, we're going to break into sort of some of the key areas that we will be unpacking throughout the year, starting with the goals and foundations, property, superannuation. We'll touch on the value of advice, questions that we get a lot, and then close out with some general ones at the end.
Yes,
let's do it.
Let's start with goals and foundations. I think this is this point in the year where a lot of people are setting their financial goals. We're really in the peak of like new year, new me, gym memberships spike, financial engagement spikes, and I guess the challenge for all of us really is to keep people engaged throughout the year and on track. But let's start with the goals that we're seeing being set. So what are some of the most common goals you're seeing from the Equity Mates community, people you're speaking to, but also just more generally from Fox and Hare members?
Yeah, great question. And thinking about the new year and what people are saying, what's the focus, to be frank, is not too dissimilar to last year. The three key themes that we're seeing come through, and when I say majority of the people, probably about 90% of the people that are reaching out to us asking for, it's really about property. Always front of mind, getting invested or building on that investment portfolio that potentially has been started. But the number one reason is financial freedom. And financial freedom is a concept that we've seen, a couple of weeks into the new year come raise its head again. And this is a conversation that we again had many times over last year. A lot of the work that we're doing with our new members is really understanding, what financial freedom means for them. And how do we go about that? Because it's such a broad term. A lot of the work that we do is create projections. And we'll sit down with a member and go, okay, if you stick to this strategy, this is where you're going to be in 12 months' time, 5 years' time, 10 years' time, based on obviously a number of assumptions. And they might look at those projections and go, okay, that's not really where I thought I was going to be in 10 years' time. That doesn't look like how I would define financial freedom. And what that enables us to do at the beginning of the year is then pivot the strategy to make sure that when we recut those projections, it's more in line to how they would define financial freedom. It's a challenging one to define, but would encourage all those listening when thinking about setting yourself up for the new year. Let's make sure that we have a really good conversation with yourself or with your better half or your other half around what that means to you.
Now, we should also say at the top that Glen and the team, you specialize in working with people who are in that accumulation phase.
Correct.
Or that not specialised, that's all you do.
That's all we do. Yeah. So I have never helped anyone transition to retirement. There's plenty of amazing financial advisors out there that specialise in that space. All of our, the vast majority of our members, like 95% of our members, would be between the ages of, say, 25 and 45.
Yeah. Do you boot them when they turn 45?
Yeah.
What
do you do?
Great question.
You'll be kind of at that age as well. Just move
Yeah,
then,
I know.
Then
Tell
like,
me
all
about
we do
it.
is pre-retirement.
So ironically, and this may sound really quite naive, but when we started the business, I had given it no thought.
Yeah.
I was like, yep, I'm going to help accumulators. There's so much work that we can be doing to make sure that people are making smart decisions sooner rather than later. And I was so sold on that, and I'd sold myself on that, that I didn't think about, well, what would happen when our members actually got older? And I kept getting asked the question. I was like, maybe we need to give this some thought. And a thought was put forward around starting a second business entitled The Silver Fox.
Yeah.
Nice.
But then I thought, how do I have a conversation with someone when they've got to
you're
that?
the
You're
Silver
like,
Fox.
it's come to that time where you've got to move
You're
into the
old
silver.
now,
Fox. So our approach now is we'll always be a business that will focus on attracting a younger demographic with the true belief that those changing their financial future in their early stage of life and the compounding impact that can have. So we'll always attract a younger demographic. However, as our members age, we will continue to support them through retirement.
Yeah.
So we're not going to boot them out. We're not going to put them in the Silver Fox business model, but we'll support them through that period.
Nice. Well, we wanted to ask, I guess, after we've sort of established our goals, we wanted to have a bit of, I guess, a health check for the year. Recheck some of the foundations, make sure they all are looking good. So what are some of the simple things we can all do as this sort of checklist to make sure our finances are healthy or trending in the right direction?
So I can share with you what my partner and I do.
Yeah.
And so we often will go away for the weekend. It might not be anything flash. It could be camping or whatever. We'll set ourselves up at a nice pub. He'll have a few ciders. I'll probably have a bottle of wine to get the creative juices flowing. And we'll open the laptop. And we have a spreadsheet that we've been running, very romantic, I know, that we've been running for the last couple of years that has all of our goals. So what we do in terms of our financial health check is review the year that's just gone and go, what did we achieve and what did we not achieve? So very similar exercise that we go through with our members and are going through at the moment with our members. So we go, what did we achieve? What did we not achieve? And then we reset for the year ahead. So we've planned a weekend away in a couple of weeks' time. We're going to open that spreadsheet and we're going to have a think about what is important to the two of us, both individually and as a collective. And then on the other tab is our cash flow spreadsheet.
Nice. And
And then we work out how are we going to manage our cash flow this year in line with what we've told ourselves is important to us. And the reason why I really love that exercise is it gives us an opportunity to reflect on what we've achieved. And it's really cool, having done this for a couple of years, to reflect on the last couple of years now. And sometimes we don't, most years, there's a couple of things that we don't tick off and then we reprioritize. Is that something that we want to focus on this year, or is that no longer a priority? So starting with the goals, pivoting the cash flow strategy, so making sure that aligns to, again, what's important to us. And then more myself as opposed to my partner will then review things like our superannuation, our investment strategy, review that we've got an investment property. Is that still in our best interest to retain, or how that's tracking? And then just check all of the different components. Do I change super every year? Definitely not. Do I pivot my investment strategy every year? Not necessarily. But it is really important that we're really clear in terms of what it's doing and what we want it to do for the year ahead.
This question, Glenn, has come from a community member, and it's around cash flow. And the question is, most advice is to keep fixed expenses like your home loan or rent and bills within 50% of your total salary. What's your thoughts on this in a market like Sydney?
So don't base your finances on an arbitrary percentage that's floating around on the internet.
Nice. Enough said.
And the reason I say that is if the advice is to keep fixed expenses within 50% of your total salary, how does that look different from someone on a $100,000 salary to someone on a $300,000 salary? To me, that's a recipe for lifestyle creep.
Absolutely.
So, and this is again got to circle back to genuinely what's important to you. If having, purchasing a property and, you're a bit of a homebody and that's, you want that sense of security and that's really important to you, that's what you should be focusing on, acknowledging that may go above the 50%, meaning you're probably going to have to taper back on your overseas trips, right? So it's that trade-off piece. So the percentages are a starting point, but it's also a very arbitrary figure.
Yeah.
It needs to be, a cash flow strategy should be clearly aligned to the goals.
Yeah. Pretty
Yeah, I love that.
straightforward.
Well, you mentioned property there, and unsurprisingly, we got a number of questions around property. So the first one came through: I want to buy a property in a few years. Should I still invest into shares, even though I would need to liquidate them in a short time horizon?
Yeah, if you're going to buy a property in the next few years, then the stock market potentially is not the place for your funds. Now, the reason I say that is because obviously, as we all know, or listeners know, that the market is volatile. Thinking about what's playing out around the world, what played out last year, the markets have and always will remain volatile. If you're reflecting on that question, a couple of the key words that I'll hang on there is if want and have to buy in the next couple of years. You've got to make sure that you've got that really healthy cash reserve to obviously put for the deposit. You don't want to take the risk. In saying that, and this is a conversation that I have quite regularly with our members, is if there is a degree of flexibility in terms of the time frame, then we want to make that money work as hard as possible. So if you said, yep, Glenn, 3 years, I have to buy it in 3 years, cash is probably the best place. It's a fairly short time frame. But if you said, could be 3, I'd be happy if it was 5, it may be 7, then arguably we probably don't want to just keep our money in cash for the next 5, potentially 7 years. So there's an opportunity to make our money work a little bit harder. And as the listener proposed, considering putting a portion of those funds or disposable income into the stock market.
How often do you have people come in saying, I want to buy in the next couple of years, and then you have to have that conversation of, is this realistic?
So where the property conversation starts is, I want to buy a property. And that, yep, I understand that. But a lot of the work, again, that we do is really drilling down into what it is that you actually want to achieve. So is it a property that you want to live in? Is it one, what's the price tag on that? I encourage people, if they're not sure as to what the price tag is, to go away, look at the realestate.com and look at the sold properties on realestate.com rather than what's for sale. So you get a clear understanding in terms of what is available. And then we work backwards from that. So if we're looking at a $1 million property and we then look at their disposable income on a monthly basis, we then map out when they're going to be in a position to be able to do that. We also share with them, once they've purchased that property and they've probably in most 99% of cases taken on a mortgage, we then share with them what their position is going to look like post-property.
Yeah.
Because that's also really important as well. We want to make sure that they're comfortable and have the capacity to purchase, but we also want to make sure that they're comfortable and have the capacity to live the life that they aspire to post the property as well. So a lot of the work is, again, defining that property goal. And in terms of the time frame, often we do find that our members are quite, it's not all, but our members are quite flexible. Like, want to buy a property, not 100% sure if it's something that we're working towards. It doesn't have to be straight away. It may not be the next 3 years. And if we start tipping into the 4 and the 5, then the conversation will pivot beyond just saving in cash to, okay, well, let's look at some other high growth investments as well, given that we're kind of pushing out that time frame.
What about the flip side? We got a question here from someone: I don't want to buy a property. What risks are there with not buying property until you retire?
Yeah.
Or actually, sorry, I think that the question is also if you never buy property, not just if you don't buy it until you retire.
Yeah.
Just what risks are there? Yeah.
So you don't fulfill the great Australian dream.
I know. Well, it does feel like there's a greater and greater cohort of people that will be in this position.
Yeah.
And it feels like a generation of Australian retirement policy has been built on the assumption that people own their own homes. So it's a question that we're seeing more and more, and I'm sure you're seeing it more and more as well.
Yeah, and it often comes down to that flexibility piece and how people define financial freedom for them. And flexibility is something certainly that a lot of our members have there's a lot of value for them in having that degree of flexibility. An interesting stat for you here, though, is that boomers who do not own their own home are more than 3 times as likely to be living in poverty in Australia. So if you don't own your own home as a boomer, 3 times more likely to be living in poverty.
Before people panic too much, there is a causation v correlation question there.
Yeah.
Like, is it causative? They don't own a property, therefore they're living in poverty, or they haven't earned as much and they're not as financially literate, and so they both are living in poverty and can't afford it.
Completely.
Yeah.
So there's a number of things here. So circling back to the question, you do not have to purchase property in order to avoid living in poverty, and that I want to make that really, really clear. I love property. I've got an investment property, but I also have a very diversified stock portfolio as well, and believe that having a diversified approach is the right thing to do. We do have a number of members that have no interest in purchasing property, and that's perfectly okay. What we need to do, though, is to ensure that we still are making our money work hard. And what I mean by that is purchasing property, you subsequently get a mortgage, you are then forced to pay that mortgage on a monthly basis. And this is simply just the psychology of money. The rates of default on mortgages in Australia are incredibly low. People do, and again, this is a very general term, but generally speaking, Australians are very good at making those mortgage repayments, albeit obviously quite high. If you do not purchase property, you have to make sure that monthly paycheck that comes through, whatever it may be, is that you are still building wealth. So to give you an example, if we've got a 30-year-old that took out a $1 million mortgage, they would be paying about $6,000 per month in repayments, assuming a 6% interest rate. So I'm 30, I take out a 30-year loan for a $1 million mortgage at 6% interest rates. I'm paying about $6,000 a month. I took that same $6,000, invested it into the stock market at a 6% return over a 30-year period. I would end up with a portfolio at the age of 60, so 30 years later, at a value of $6 million.
And that's 6%. I think you're underselling it,
Yeah, I
Glenn.
reckon
You're
undercooking
undercooking
it.
it.
Well, so you'd be right, but I wanted to use a
course.
conservative figure there. We should definitely be looking for returns greater than 6%, but being conservative. So just to recap, right? We take out a $1 million loan at age 30. We're paying $6,000 per month in repayments, assuming a 6% interest rate for the next 30 years. The alternative, I invest $6,000, generating a 6% return. I end up with a $6 million portfolio.
I love that example so much. You have no idea how much I'm going to steal that.
Take it away.
Yeah, I've never heard the choice framed like that, and it's such a good framing of the choice.
What's the risk? You don't invest $6,000 a month.
Yeah.
Right. That is a genuine risk.
Yeah.
If you've got a mortgage, you might not be able to go to Europe this year, right? It might be, you might need to save up a couple of years, or it might be Bali instead. If you're regularly investing $6,000, you're like, I need a break, I'm going to take 3 months off, or whatever the case may be, you can. And there's no one holding you account to that strategy. That is the genuine risk with that.
People will then also argue, we've also got to factor in rent during that period of time, and the risk is you don't have...
True, that is true.
You don't have a
Yeah,
house.
yeah.
Yep.
And I understand that. But
Yeah,
fewer numbers.
You should say, I guess the actual counterfactual is taking that 6,000, subtracting what you'd be paying for rent, and then investing the difference and what that looks like.
Yeah, completely.
Yeah.
That very, very fair.
Yeah. Still,
That's good.
Yeah,
Yes.
6 million. That's pretty nice.
That's not bad.
Why did we
That's
buy a
not
house?
bad.
Why did we
but
buy a
also,
house?
but also think about again why even the last couple of weeks, why are people reaching out to us? Freedom. Do I want to take out $1 million mortgage for the next 30 years?
Yeah.
Or do I want to rent and move around, live in different places, live by the beach and then do the countryside for a bit? Appreciate that everyone's circumstances are different, but leaning on the stock market does give you that degree of flexibility.
So I've just quickly punched some numbers into the compound interest calculator. CoreLogic have the average Australian monthly rent at $2,700 a month.
Yep.
So you subtract the $2,700 that you're paying for rent, and you've got $3,300 left over.
Yep.
That's so put that in each month over 30 years at a 6% using your 6% return, 3.2 mil.
What happens if we bumped it up to 8%? Let's just be a little bit.
Well, to be honest, I actually thought the 3.2 mil still proved your point. But if we bump it up to 8%, 4.5 mil.
That's pretty healthy at 60 years old.
If you bump it up to the 124-year average of the Australian stock market with dividends reinvested, 13%. 11.7 mil.
No brainer. Cut property from the strategy.
What's the risk? You don't invest.
Yeah, you don't do that.
You spend that 3,300 on the flights to Europe.
To Mykonos. Which sounds appealing, but think of your future self. And you have to remain disciplined. Property, that mortgage forces you to. You have no choice. The stock market doesn't force you to.
Until Equity Mates come out with a 30-year principal and interest loan that is invested in the stock market.
That would be good.
At 13% returns?
Not guaranteed.
Guaranteed.
Past performance is not an indicator of future performance.
Glenn, our final question on property is, it's quite topical because this is something that will become a big debate with the federal election this year. And that is using superannuation to buy property. What are your thoughts on this?
So there's two ways I can interpret that question. The first was, do I buy property through my super fund? So considering a self-managed super fund. For me, the costs of administering a self-managed super fund need to be taken into account. So generally speaking, we're only seeing those with quite high balances that before we would consider going down that path. Also in Australia, most people's biggest asset is their home, so then moving their super into property as well obviously reduces the diversification piece. In terms of people taking money out of their super to purchase their first home, I'm firmly against it. The compounding impact of someone in their 20s and 30s taking out $10, $20, $30, $40, $50,000 and what impact that will have on what their future retirement savings looks like will have a detrimental impact on that comfortable retirement that most people aspire to. For those listening and thinking about where we are in the year, setting goals, thinking about if you were in a position where you did have to take out funds from your super during COVID, then one of those goals may be looking at recontributing those funds if you're in a position to be able to do so. Putting that money back into your super in your 20s, 30s, again, will have a positive impact on what that retirement savings would look like. So, and I also do believe in the argument that taking funds out of super, also for first home buyers, is just going to inflate prices, which again is obviously not what we want to be seeing around the country.
Well, holding on super for a second, we've got a couple of other questions that came through around super. This one's quite general. The question is in their late 20s, and they wanted to know what your personal views on additional contributions to super are. I can preempt the answer to this question, which is you like additional contributions because you're a financial planner. So maybe if you can give us a bit more of a decision-making framework about like when people should be making those additional contributions.
The biggest mistake I see when people make additional contributions to their super is they don't know what they're investing in. So they put their money into superannuation, yes, there are tax benefits in terms of doing so, but then they don't know what those funds are being invested in. So in terms of a framework, if you're going to make the effort of putting those additional funds into super, then you need to be understanding what fees are your super fund charging you, how well it's performed over the last 10 years, acknowledging past performance isn't a clear indication of future performance, and also whether you're comfortable with the companies you're invested in through your super fund. You know, you wouldn't put your money in a high interest bank account without shopping around for rates, right? So why would you do the same? Why wouldn't you do the same for your super?
I guess the follow-on question then is, like, do you have a default position for all members that regardless of, well, like a component of it is we're just going to make additional contributions, be it $50, be it $100, be it whatever?
No, there's definitely not a one size fits all. It is certainly based on individual circumstances. So an example would be for potentially someone looking to purchase their first home. So we would consider putting additional contributions into super, because through the First Home Super Saver scheme, Google it, I won't go into it now, but you can then take those funds out of super. So you're getting the tax benefit, but you've also got the flexibility to take it out to go towards your first home. If you've purchased a property before and you're potentially looking to upgrade, etc., probably a different story. You're not able to access that scheme. You might need the additional funds in order to purchase that upgraded property, which is important to you. So you may not be then making those additional contributions. So it's not a one size fits all. We would like to see it as part of most members' strategies, but in terms to what extent does vary based on individual circumstances, as well as always goals.
Yeah.
Now, one more question about super. We got a listener who's moving to London, and I feel like they're not alone. I feel like a lot of our friends have made the move. And they just want advice around super. Is there anything they should be doing with their existing super when they go overseas? Can they ensure it's continue to tick over?
Yeah. So many Australians move overseas to London or New York and come back with nothing, or even worse, debt. I love that someone has actually thought about their super fund before moving overseas.
That's the Equity Mates community.
That is awesome. And interestingly, last year I had a chat to one of the journos from the AFR about this exact topic. You know, moving to London, moving to New York, and then forgetting about the position that you come back to in 5-6 years' time. You know, super or the otherwise, you don't want to be in a position where you come back 5 years later and you financially feel you're in exactly the same position as to when you left, having earned potentially really good income while overseas. So thinking about super specifically, again, circling back to the question, we want to make sure we want to go through the health check process, fees, performance, etc. Before you leave, but also be conscious of it while you're over there. There was a change in legislation a number of years ago now, where if you didn't max out your contributions, you can actually make additional contributions and claim those as tax deductions. So previously, each year, if you didn't max out how much was going into super, it was a lost opportunity. So if you're planning on going to London or wherever the case may be, when you do come home, you could make larger contributions to super that'll have a positive impact on, I guess, your tax liability, reducing your tax liability. So that's certainly something to consider.
Nice. Yeah.
And the government brought that legislation into place for another number of reasons. And one of the reasons is the super system in Australia does disadvantage women. There's the gender pay gap, which we're all aware of, but also women are often the primary caregivers when starting a family, and super contributions is based on your income. So if you take 12 months off, that can have a significant compounding impact on what your retirement savings will look like. Often, again, women after that 12-month period, if they're the primary caregiver, go back part-time. So again, in their formative years, in their younger years, they're not making the same. Their employer isn't contributing as much to their super fund as their partner potentially. So gone a little bit off track there, but the concept is broadly the same. If there's a period where you're not contributing, that's okay. but just be conscious that you're not contributing, and then work out how do we get back on track when you're in a position to do so.
Yeah.
Nice.
Nice.
Glenn, we've had a bunch of questions come through from the community around the value of advice. So this one is from a community member. They say, I earn a good salary and feel like I could be doing more, but advice seems expensive. What is the cost of not seeking advice?
Good question. So, I mean, I wouldn't have a business if I couldn't articulate the value. So I hope I answer this question okay. Advice is expensive, but there's also a lot of value in it. And potentially the best way for me to answer that question is maybe to share with you, a case study or a story for a couple that I've been working with for a couple of years now. So young gentleman, when he first reached out, he was in his late 20s. We've been working together for about 3.5 years now. He was putting a little bit of money aside in raise, but wasn't really kind of proactively managing it. Had a bit of savings in cash, but again, not a huge amount. And he had a nice Audi. Right? That was his scenario. Fast forward 3.5 years, he's got about 100 grand in savings, and I should say over that time his partner also joined as a Fox Hare member as well, so their relationship over that period got a little bit more serious, so she joined on as well, and joined those conversations. So they've got over 100 grand in savings now. They've been regularly investing for the best part of the last 2 to 3 years, about $2,000 per month, and also they've made some other additional contributions when they had the ability to do through bonuses and things like that. So they've got a portfolio that's just ticked up over $200,000. That's generating them, circa $1,000 per month in passive income, which is being reinvested. They've bought a $1.3 million apartment, which is a huge, milestone for them, and also got married over that period. They're in the process of looking to upgrade, so they're looking to start a family in the next couple of years. So we're planning around, time off and things like that. So they're looking to sell that apartment. For them, that's the right thing to do. We looked at potentially retaining it. The property hasn't actually grown a lot in value, and based on the rent that they would get from being able to rent out that particular apartment, the numbers just didn't stack up. They originally wanted to keep it, and it was a psychological thing. It was the first property they'd lived in together. It was the first property they'd bought together. But when running the numbers, they were like, actually, you know what? That's not the right thing for us to do. So we're looking to sell that and then buy a bigger property. They've saved about $25,000 to $30,000 in tax over the last couple of years, because we're really conscious about the investment structures that we're using. Really simply, the investments aren't in, I'll just use Phil's name. It's not his name, but I'll use that as an example. The investments aren't in Phil's name, because in this scenario, he's the higher income earner. The investments are in Lil's name. So from a household perspective, we're obviously paying less tax, and we've also made additional contributions over that period to their super. Their super fund has returned certainly over the last financial year, has returned double-digit returns. So Phil also receives shares from his employer as part of his kind of package. So we've got a really clear strategy around how to manage the tax associated with that share program, but also we're looking at diversifying, because he's acknowledged that his exposure to that one company has grown since he's been there as well. So we're looking to manage the risk associated with that, and again, look at a more diversified approach. So we've gone from a scenario where Phil and Lil had, a bit of money in cash. They've dabbled in raise, and they've got the Audi, to a situation where they've got a really clear, holistic plan, looking at everything from cash flow, their investment approach, how it aligns to a passive income, a regular investment strategy. All investments have been considered from a tax perspective. We've saved about $25,000 in tax. Their super fund is in an ethical fund for this couple and has generated double-digit returns. And there's a plan around the employee shares.
Yeah. Now, Glenn, the one thing about Phil and Lil that people might be listening to that and saying, well, that just isn't realistic for me, is how much are they actually earning as a couple to to be able to do all these things?
So Phil is earning about 200 grand. So he's on high salary. Lil, she's earning about 100, 110.
Okay, so as a couple, it's about
300.
300.
Yeah. Nice.
Pre-tax, yeah.
Pre-tax, yeah.
So I guess the sort of the follow on from that is around when is the right time to start seeking advice. The Phil and Lil as a couple, $300,000 household salary. Like, what level should people be getting at, either as an individual or as a couple, and being like, okay, now we can go and see Glenn. And I guess like the corollary of that is people just often have questions around like how much should they actually be paying for advice.
So starting the year fresh, we're thinking about what's the plan for the future. And we get a lot of people reaching out to us at this time of the year. In terms of when is the right time for us, and this does differ for us. If you've got a disposable income of between $2,000 and $2,500 per month, we want to be having a conversation, because that tells us that you have a surplus that we should be proactively doing something with. Okay, so saving money in a Ubank account or an ING account or a Macquarie account, it's all well and good, but we need to understand what it is that we're doing with that disposable income, and then how it subsequently aligns to the goals.
Disposable income, do you mean like after tax income, or
Correct.
you mean okay?
Yeah, so this to clarify, so this is like once all the bills are paid, once you've done your groceries, mortgage, rent, whatever it may be.
So it's like, do you have the ability to save over $2,000 a month?
Exactly. Save or invest over $2,000 per month. We want to be having a conversation.
Does that include the cost of advice, or is that after the cost of advice you still have $2,000 left over?
After the cost of advice.
Okay, yeah.
Oh,
that's a good.
So all said and done, you got $2,000 left over.
Okay.
Why does that differ to most firms? Most firms look at net worth.
Yeah.
So are you a multi-millionaire?
Yeah.
Why do we not look at that? Because our members have aspirations to be multi-billionaires, but they're also, early on in their journey. So what we're looking at is the opportunity to create wealth. And what drives that opportunity to create wealth? The money that you have at the end of each month to either save or invest. In terms of the cost of advice. So we did a number of focus groups before we launched the business, and continue to do so every single year around our fees. And the question was posed to the table of about 10 or 12 people. We had plenty of food and lots of wine, so we made sure that they gave us their honest answers. And we asked them, should we be putting our fees on the website? And the room was split. So half the room said, yep, put your fees on the website. If I don't have any idea in terms of what they're going to be, I'm not going to reach out, because I don't know if I'm wasting my time or not. The other half of the room said, if you put those fees on our website, I'm never going to reach out because they look really expensive.
Yeah, that would be my gut.
Yeah. So what did we do? Our fees are not on our website. However, we have a framework where if you do reach out to us and book a call through the website, you'll sit down with one of our member success managers for about 30, 45 minutes, potentially an hour. It is free, and we'll tell you exactly what the fees are going to be in that free conversation. And the reason why we do that is because obviously we want to be really transparent. We also want the opportunity to be able to clearly articulate the value advice based on your individual circumstances. And we don't feel like reading a website is really going to be able to do that. So the first call is always free, gives us the opportunity to articulate the value, but also be really transparent around the fees. In terms of what the fees actually are, so they do vary quite considerably. So the minimum fee is $4,000 upfront as an individual, and that goes all the way up to around $12,000 upfront as a couple. In terms of what your fee would be, it would be clearly articulated in that first free. We call it a virtual coffee, that first free chat you have with one of the team. So it's really clear. It's a flat fee. It's not percentage for how much wealth you have. So that's the initial fee, and then the subscription. So we run a subscription model, which our members are really comfortable with because it's clear, it's transparent, where the subscription varies anywhere between about $290 per month up to nearly $1,000 per month. Again, depending on individual circumstances and complexity. It is a flat fee. There's no lock-in contracts. There's no minimum term. So the onus is always on us to show value in order to justify the fee. If a member is not seeing value in the engagement, so potentially they got to a point where they're like, "Yep, this is awesome. I'm sticking to it. Don't think circumstances are going to change. I'm really comfortable where things are at," and they subsequently cancel. That's okay. But if then circumstances change and we need to provide updated advice, legally we're obligated to provide that advice in writing. So it is personal advice, so very different to general advice. That's all included in the subscription.
Yeah.
Nice. So to reiterate, for Fox and Hare starting from 4,000, but I feel like that's generally where the industry is sitting at the moment. So.
Yeah, and you look at that fee and you go $4,000, but if you've got a disposable income of $2,000 per month, that's 2 months of disposable income to review every single aspect of your financial world and provide bespoke, tailored advice.
Glen, Harriet and I have dated the field. And what I mean by that is...
And then they found each other.
Yes. And that is our story. We took the opportunity, as you said there, to speak with a number of advisors because of this free, no obligation chat.
Yeah.
And I think it's a really important thing that people should do if they're trying to find an advisor.
Definitely.
Because the conversations we had were all very different.
Yeah.
And how the advice firms approached it, who they put forward, it was all very different. But what sort of came out of it was like Harriet and I mean, I'm very privileged to be in this, have been doing this show and have spoken to a lot of you guys, and so have a bit of an idea. But Harriet going in was a bit unclear on like what she should be asking so that she could get a vibe on who to choose, because a lot of it is you guys trying to sell us in a way. It's kind of like, here's our process, here's our fees. And a lot of what you guys say can be very similar. And until you get to the point of being shown the advice, it's a bit hard to make the call. So what should we be asking you guys in these calls to make sure that you are the right advisor?
So you should be asking the financial advisor that you're sitting in front of what percentage of the people that they work with look like you. So if you're sitting in front of an advisor with Harriet Bryce, and they say, oh, maybe like 5% of our members are in their 20s, 30s, but most of our members are pre and post retirees, then I suppose the question is, well, do you have a grasp in terms of what the priorities are going to be for someone in that accumulation phase? Which is why we specialise. I do believe that specialisation is important in our profession, whatever that may be. Some advisors specialise in pre and post retirees. Some advisors specialise in sports people. Others it's actors. Whatever it may be, because everyone has quite different nuances to how their financial world is, I suppose, crafted. And if you're sitting in front of someone that doesn't have a lot of experience with accumulators, then they're probably going to be focusing on things that potentially aren't that important to you. You wouldn't go see a dermatologist if you had a broken arm.
No.
You know what I mean? Like it's important to make sure that you're working with someone that gets you, that understands you, understands the opportunities, but also understands the challenges.
Yeah, it's challenging because what you guys all say is all very similar, and so for us it was like, is there a level of confidence in knowing our situation and our age?
Can I ask you potentially a question that may offend Glen, and I hope it doesn't? No. Is part of the reason they're all saying similar things is at the end of the day, good advisors should have similar advice? Like none of you, like if you're a terrible advisor and you're trying to put Bryce in like specky mining companies and not optimized for tax, like obviously it'll be different. But surely like good advisors will all cluster around quite similar strategies, because like when it comes to some of this stuff, there is like an optimal way to structure your finances and invest it. And
well, I
is
think
that fair to
something
say?
we found out through dating the field, sorry Glenn to cut in there, but is like we found out that there was a definite bias towards particular asset classes between some of them, in terms of like what you would do with your money. Like,
but is that because you're at your age and you've got X time horizon and you've got X risk tolerance? Like they're hearing what you're saying and they're all talking about similar asset classes?
No, I mean like one was like no discussion around stock and whatever. It was like, let's, property.
Oh, really?
Yeah.
Others were like hard. There's no point doing superannuation extra right now because of your age. Others might be like, we should try it. Like there was a clear,
that is interesting.
There were clear biases internally on how they thought you could get to your goal, I guess is the point. Yeah. And so for us, that was then like, oh shit, now it's kind of like, how do you work through that?
Yeah. So you've got to have like a level of financial literacy yourself to then be like, I'm not sure that's right.
Yeah, well, I guess so. And
I don't think that's fair. Like, if you're going to see a financial advisor, you shouldn't be expected to be a financial advisor.
100%. Yeah.
And there's a level of trust, right, with any professional service that you engage with, whether it's an advisor, an accountant, a lawyer, whatever the case may be. There is going to be a degree of trust involved in the relationship, rightly or wrongly. But you need to be thinking about is the person that I'm sitting in front of with, do we resonate, and do they understand what I'm trying to achieve? And our approach has always, so one of our internal mantras is empowerment through education. We are firm believers that any advice that we put forward, regardless of the member's level of financial literacy, the more that they understand it, the more likely it is they're going to stick to it, the strategy itself, and then they're going to stick to it because they understand how this aligns to the goals. So if you're sitting in front of an advisor and they're giving you advice, ask them to prove why that is the strategy that you've put forward. Don't be afraid to do so. And a good advisor, to your comment, Ran, should be able to clearly articulate and why they've put that advice forward and why it's in your best interest, and also what alternative strategies they've considered and why they've discounted it.
Well, I think that's a good point to say. Hearing Bryce's experience and the array of advisors that may have different views on different things out there has you worried, the place to go is equitymates.com/advice, because we will match you with advisors that we've handpicked and we're confident won't put you in the specky mining stocks unless you ask and you have a very small percentage of your salary. But they're advisors that we've worked with, that we've met with, and that we're confident can deliver a good service. So equitymates.com/advice if you want to speak to Glenn or his team or any other financial advisors. But Glenn, thank you for jumping on the podcast today. We're sure you'll be back soon. But I hope that people have got a lot out of this and are ready to set up for a big 2025.
Yeah, and I just wish everyone luck with their New Year's resolutions, and just stick to it, stick it out. It's going to be another big year, but stay focused, and if you get off the horse, just get back on.
Nice.
Yeah.
Thanks,
Nice.
Glenn.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.